Hey everybody, it is good to be with you as usual on Fridays, Condors, Calendars, and Butterflies. I'm grateful to be here with you today. I'm grateful that you're watching live, if you're watching live, and if you're watching on a recording, I'm grateful for that too. Today I want to talk about volatility and your option trades. We're going to get to that in just a little bit, but before I do so, let me just mention this. James is in the chat with me, James Boyd. I appreciate James. So, I encourage you to follow James. I've been working with James for a lot of years now and a couple decades now. And hey, feel free to follow us on X at Brent Moore CS, at James Boyd CS for additional content throughout the week. And before I get too far into this, though, let me just mention that options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes only and educational purposes there. So there's no recommendations here. We'll look at individual symbols, but those aren't suggestions of trades. Nor am I suggesting you use a particular strategy, but I want to educate you on different strategies. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is provided for educational purposes only, but that does not assign short options early. So that's a difference between paper money and the live platform. And all investing involves risks, including risks of loss. And there's no guarantee that execution of a stop order will be at or near the stop price. Past performance is no guarantee of future results, and probability analysis results are theoretical in nature. Schwab does not recommend the use of technical analysis as a sole means of investment research, and I probably won't factor in commissions in our trading here today, but keep in mind commissions and fees are a real thing. This is the market. We're up again today, all-time high on the S&P 500 earlier today. I want to talk about volatility, but before I get to volatility, let me mention this. Starting next week in this webcast, it's just going to have a different title. It's going to be called Advanced Options instead of Condors, Calendars, and Butterflies. And I think that's a good thing because we cover more strategies than Condors, Calendars, and Butterflies in this webcast. And I think the name will represent a more complete view of what we do here. So just don't be thrown off by that next week there. Now, we talk about option Greeks. We talk about implied volatility with options. And it matters because option prices can be moved by different things. Of course, it can be moved by, say, the underlying stock. I'm just going to bring up IBM here as an example. Here's a chart for IBM. IBM's have a nice move up. If you had bought a call option a little while ago, you'd probably be doing quite well on this with this move up in IBM. If you bought a put option, you would not be doing very well, I'm pretty certain with that. But there's other things than just the underlying stock movement that can affect things. Time decay can affect your contract for the good or the bad, depending on what kind of contract you're doing. And so can changes in implied volatilities. And so we often will talk about Vega. Vega is just a measure of how much that option trade can be affected by your implied volatilities. And I just want to give you an example of that. First of all, what I'm going to do here, I'm just going to bring up implied volatility on a graph. And I'll show you how to do this in just a little bit. But notice implied volatility right now is around, 53%, 54% right now. And this is higher than where it has been. If you look at this, if you look at where it is now and compared to where it's been for a lot of the year, which is down in here, which is below the 40, could you imagine that maybe IBM would settle back down to one of those levels? So how would that affect the trade? Well, let's just take a quick look at how that would affect the trade. A 15-point drop in implied volatility, for example. So I'm going to go to trade, bring up IBM, and I'm going to use a little tool here called the Theo Price tool. I'm just going to click on where it says Theo Price Mark. I'm going to click on this, and I'm going to say, what if our implied volatility dropped 15%? I'm going to put a minus 15% here. And all this tool does is it tells us how the option trade could potentially be affected. It's not perfect in giving you what an exact price is going to be, but it gives you a decent estimation. Let's just go out to the monthly contracts and say we were looking at buying a call option on IBM, and we'll look at the at-the-money contract, which is going to be about $290. So if we look at that contract, right now it would cost us, well, we'll use the mid price, around $13.65 here. And if the stock didn't go anywhere, okay, I'm not making any change in the stock price right up here. I'm not making any change in the date. So no change because of the delta, no change because of time decay. We're just looking at that implied volatility drop. That $13.50 option goes down to $9.50. Okay. That's it dropped a third of its price based on the implied volatility drop. And that seems like a realistic implied volatility drop. Okay. Now, what's not realistic is no days, elapse and no stock price change. But the point being, I wanted to isolate your implied volatility just to show you how big of impact implied volatility can have on that option trade. In this case, it was working against us in this example because implied volatility dropped and we were modeling a long call option. Hey, if we were modeling a short call option, it would have been great because we want the price to drop. So that's just that's going to tell you, this just gives you an idea of that implied volatility change. Okay, and often we'll use Vega as a measure of that, which just tells us how much the option price is going to change per 1% move in implied volatility. Okay, and it's a moving figure. If you look at this number later today, it'll be a different number, but it gives you a decent estimation there. So let's just reset that. So volatility can help you, it can hurt you. It's probably not the biggest factor. Usually the price change in the underlying stock is going to be a bigger factor, but it can be a pretty significant factor. Now, if we're looking at the markets as a whole, we can measure volatility. Often we'll use the VIX, kind of a standard measure. It looks at S&P 500 options. But this doesn't necessarily tell the whole story because this is for options on the S&P 500. But some stocks go up on a particular day, and on that same day, some stocks are going down, and it kind of moderates the amount of the move on the S&P 500. So a VIX of 15 may seem kind of low compared to what your perception is of these daily moves that you're seeing in the stock. Let me give you another symbol that we can look at. VIXEQ, which is the constituent S&P 500. In other words, instead of looking at the implied volatility of S&P 500 options, this is looking at the individual stocks in the S&P 500 and looking at implied volatilities on those. And you're seeing a very different picture here on that. So don't get lulled into this false sense of what implied volatility could be based on the VIX necessarily, because individual stocks are actually still have quite a bit of volatility in the market right now. Okay? There's a difference there on that. Now, what we're going to do is we're going to look at individual implied volatilities on options. So how do you do that? You can add implied volatility to the chart. But before I do that, let me just mention this. There are different types of trades, and implied volatility affects different trades in different ways. So there's what we would call a negative Vega trade, which means they benefit if implied volatility drops. What are those kind of trades? Well, maybe a short call. Okay. We'll say, I have my caps lock on. Let's try that again. A short call, that would include a covered call there, would be a negative vega trade. A short put, just a single short put, would be a negative vega trade. A short call vertical or a short put vertical, provided that they're out of the money, which is how we typically do them, those would be negative vega trades. They would benefit if implied volatilities go down. Butterflies are negative vega trades. Iron condors are negative vega trades. So those are just some examples there. There's positive vega trades, and positive vega, you're just going to flip it around. Instead of a short call, you'd say a long call is a positive vega trade. A long put is a positive vega trade. A calendar is a positive vega trade. A diagonal is a positive vega trade. What else? There's, I'm not going to be, this isn't going to be an exhaustive definition here or list. A long straddle or strangle would be a positive vega trade. I'm not going to write it down, but a short strangle would be a negative vega trade. So that's just some examples there of what we talk about. So how do you approach it? Well, typically, I'll tell you the typical way that traders will look at it. They'll say, look, if the IV is very high and we expect it is going to come back down, then we're going to probably focus on a negative vega trade. If our IV is particularly low, then we'll probably focus more on positive vega trades. So that's how that works there. So how do you view implied volatilities on a graph? Well, let's do it. Let me move this out of the way. You can pull up a stock and let's just do, I don't know, it doesn't matter. We'll go back to what we were just, we were looking at IBM, okay? And I mentioned that you can add in implied volatility. I have a quick link here. I'll show you how to add that quick link. If you don't want to use a quick link, that's fine. It's just a study, implied volatility. Just go to your little flask there. It's alphabetical. Go down to applied volatility and you can add that, okay? If you want to do a quick link like I have, and I use it a lot, you can quick link whatever you want on there and look at different charts or different study sets or different styles. You can quick link all those on there. And the way to do that is you go up to the gear, click on the gear, that gear, there's a lot of different gears, and where it says My Tools, make sure it says On Each Chart, okay, On Each Chart. That's the first thing you gotta do. Then you click on OK, and then when you do it, you'll have a little gear over here. So different gear, click on that gear, and it will give you the choice to add what you want. Now, if you have too much, if you add a lot of stuff on this, hold on, okay, let me go back. It didn't like that. It says I'm in editing mode. Okay, let me see if I can get out of this. Well, let me reset that. Let me just reset that. Okay, let's try this again. Oh, yeah. Okay, hold on one sec. I'm just going to go back and I'm going to go back to my workspace here and reset that since I had a little error message. And that should load up for us in just a sec. But let me just mention this. When we were looking at this, and I'm pulling up charts here. There's my chart. Okay. Let's go back to this. If I want to use these quick links, you go on each chart, and it gave me an error message last time. Do that, and then you can click on the gear, and then you can add, it gives you the choice of adding different things. I just added the implied volatility study on there, okay? If you end up with more than can fit on there, you get the little arrows there, and it gives you a drop down of other things you can add, okay? So But here's the nice thing about this implied volatility. It gives you the history, okay? It gives you the history of it. And so when we're looking at this, and I can see here it is now, but I can see where it is compared to where it's been, whether it's high or low. Whereas if you just look at just a plain implied volatility number, who knows? Some stocks naturally have higher implied volatilities than others. This can probably give you a little better sense of what we're looking for here on this. All right. So that's the first thing I want to mention to you. The next thing on this is if you want to find implied volatilities of a certain level, there's different ways to do it. One way is you can use a scan, go up to scan, and I have a couple scans saved. You can load your scan query. And once you save the scan, then here's a high IV scan. Once you save the scan, it will automatically add as a watch list for you. And I have a low IV scan as well that I've saved. If you are interested in those scans, I'm just going to drop those into the chat. First one is the high implied volatility scan. The second one on the list is going to be the low implied volatility scan. And I've also saved those in the description of this webcast for those of you who are watching on a recording if you're interested in those scans. But here's my point. Let me click on charts. Let me bring up my left-hand column here. And if I go to my scans, personal, I can go to my high IV scan. It's right there. Pull that up. And this is essentially the results of the scan on the other page. But it makes it easy. You can always just look right here if you're interested in that. And I can see stocks that have higher implied volatilities that meet the parameters of the scan. So I've got Oracle and IBM. I deliberately picked IBM because it was a big mover there, though, and AMD and Qualcomm and so on. Okay. There's other ways you can do it, of course. You can go to a list, go to, say, S&P 100 or whatever your list is. You can customize that, and you can add in a column called IV percentile. Okay, IV percentile. Click on OK, and it's just going to give you the IV percentile. Okay, technically the IV rank here in this case, but you can see the higher ranked IV one. So if I click on Honeywell, well, look, Honeywell's on both lists, Oracle's on both lists, ACN's on both lists. They're basically doing the same thing if you want. One advantage of using the scan is if you do the scan and create the scan, you can always just like add other parameters in the scan there. So maybe I want to say, I don't want earnings to come about. I want to find stocks that have earnings, because a lot of times right before earnings, we have this volatility spike and maybe I don't want to trade over earnings. I can just add a filter in there and I can go to fundamental, not fundamental. I clicked on the wrong thing. Let me get rid of that one. Click on study, and study filters are only available on your live platform, by the way, not your paper money. But you can go to corporate actions, go to earnings and say, it does not have any earnings in the next, we'll say next 21 days, which is roughly a calendar month. Okay. And then I run that scan and I come up with these. So it narrows it down. You can tweak those scans to your heart's content. But let's take a look perhaps at, I don't know. I don't want to do IBM. Let's look at AMD for a sec. Okay. So let's look at AMD. So here's AMD. So it doesn't matter what our implied volatility is, apart from you also need to have a forecast for the stock. That's always your first thing. What's your forecast for the stock? IVs are high, obviously. Okay. What about, well, let me put on a 20 and 50-day moving average. Oh, we're trending up. Probably don't need moving averages to tell you that, to be very honest. But we've had a nice trend up. The market's been going strong. AMD's been going strong. We're going to continue to play into this strength here. So maybe that brings us back to this consideration right here that we talked about earlier. Do I think implied volatility is going to go up or down from here? Well, I don't know. You never know for sure, but it seems that implied volatilities being as high as they are, let me get rid of this left-hand column, as high as they are, there's probably a decent chance that we'll see at least somewhat of a drop in implied volatilities. No guarantees, of course, no guarantees on that. But there we go. So, so which are we going to target in that case? If we think implied volatilities are more likely to drop, then I'm probably more likely to target my negative vega type trades. I could just do like a short put, or if I want to protect it a little bit more or do a short put vertical, I could do that. Which leads us to one of the questions that we had in the chat, which forgot who asked it, but it was on return on capital versus return on risk. Well, let's look at AMD here, and let's just look at a short put here for a sec. Okay, so let me go to trade, and I'm going to go out. I'll just go to monthly here, or yeah, the June 18th. Okay, so, and I'm going to go out. I'm going to get some more strikes. Probably don't need all, but I want more than 10. Okay, so I'm going to go out here to say a 470 strike. If I just click on this and look at a short put, I'm going to click on confirm and send here. Okay, so it's going to give me some numbers here. It's going to give me let me get my thing. It's going to give me a max profit. Okay. It's also going to give me a max loss. Now, these are not likely numbers necessarily, but they are theoretically true numbers. If I do a short put on AMD, AMD could go to zero, and I'm on the hook for buying 100 shares of a $470 put. Now, I get a credit that's going to help minimize the cost a little bit, but I'm still $45,000 risk on that. All right. So my theoretical return on risk on this is I would take 1660 and divide it by 45,000. Okay. But that's a risk that is you should consider, but it's probably not super likely. That would be your return on risk calculation there on that, which is great, and we use it. We can look at this on other trades. And that's the one I typically talk about here. There's other ways to kind of do a return on risk calculation. We could put in a stop loss on it and say, my max profit versus the loss I would get if I hit that stop loss. But remember, stop losses aren't guaranteed. Okay, so that's a little bit more theoretical. All right, it's a little bit more theoretical. Now, what is return on capital? Well, how much money am I kind of putting up here in terms of my initial capital? Basically, the buying power effect would be what we're doing, about $6,600. So I could do 1660 divided by the money I'm putting up here, which is about $6,600. That's going to give me a very different calculation there on that. Is one right or wrong? No, it doesn't matter. It's just how, what risks you want to take, and just be familiar with one, and then you can use it to analyze one trade compared to another. Let's say we take that 470 put that we just talked about selling, and at the same time, then we go and we say, I'm going to make it a spread, and I'm going to make it a 460 long put on here. Hold down my control key, click on confirm and send, and then what we're going to do is we're going to see the difference. What's my return on risk? Well, theoretical return on risk is 317 divided by 683. Theoretical return on capital would be 317 divided by my buying power on that. Okay, so I don't care what you use, but you should probably have some sense of what those numbers are when you're entering your trade there and what you're doing. In this case, it certainly ties up a lot more capital by doing just the straight short call. I can do the short put vertical, but and there's just consequences. I limit my gains a little bit. Why do I limit my gains? Because I'm bringing in the credit from the short put, but I'm having to pay something for the long put. Okay. I limit my risk. We saw that a second ago. I limit my risk, limit returns. We mentioned that. It also changes the Greeks a little bit there, because instead of just that short put vega, negative vega that we saw of 41, it'd be negative because we're selling it. The difference is going to be only about 3 points, okay? Rounding at least about 3 points. The difference between those two contracts. It still does have some negative vega on there, and I'm still going to place the trade. So that's what we're going to do. This is just a sample trade. It's going to default to the mid price. Probably not going to get filled to the mid price, but I'll go in between those. I'm going to confirm and send, and I don't have any groups out there right now because I've been tweaking that. And we put that trade in there. That's a negative vega trade. Now we can do the similar thing, of course, with long vega trades. I could go to my IV scan low, which I previously shared in the chat with you. IV scan low, or you don't need to do both. I'm just showing you both. I could go keep this and just sort it, okay? And go sort low to high, okay? Low to high and look at Starbucks, United Health Group, Tesla, Alphabet, CVS, whatnot, okay? So when we look at, say, for example, Starbucks, and I look at this, here's my implied volatility nice and low on that, okay? It's been dropping, okay? And what's my forecast? Now, very often, if you don't want to make a forecast, don't skip it. Look, there's 100 stocks in this watch list here I could look at. This is the S&P 100 watch. You have your own watch list. Maybe there's 20 stocks in there. Maybe there's 15, whatever. You don't have to swing at every pitch, right? So if you don't like what the chart looks like, then don't do it. Typically from a technical standpoint, and by the way, if you want to go beyond the basics of technical analysis, we have an advanced charting techniques webcast, which occurs right before this one on Fridays. James Boyd teaches that. Make sure you check that out. But I stick with pretty basic technicals here on this, not the advanced charting. This is pretty basic. I'm going to look at stuff like trend. Okay, I use moving averages, support and resistance. Sometimes I'll even use something like a volume profile. And for those of you who aren't familiar with this, what the volume profile shows us is where the volume is, what price is the volume has the stock traded at? In other words, if I look at a normal volume chart, okay, if I look at a normal volume chart and I go here, I could just show that. I can click on the gear, go to equities and show volume subgraph, click on okay, and I could see where the volume is on any individual day, okay? But if instead I say, I want to look at the volume profile, it's just another study, you can get that through the Flask. This isn't telling me how much trades on any given day, it's how much traded on any given price. It shows that most of the trading has been right in here. And the theory is that the stock's more likely to trade where it has traded before. And so if it's going down, it may, and we have some downward momentum right now, we could bring up a RSI and I'm sure it'd be declining, or a MACD and it'd be declining. Or you can look at the chart, it's declining, but it's probably likely to hold up kind of more in this range here. Now, if I felt this were just going to keep on going down and down and down, especially given that this is a low implied volatility type stock, where we expect if this does go down, the implied volatility is probably going to go up. We could certainly do a long put, but hey, this is our condors, calendars, and butterflies class, and I want to show you some other things. And I think that there's a decent chance we're going to hold up in this area. This is kind of an area of congestion, is how I'd consider that to be. So I'm going to call this kind of a moderately bearish trade, not uber bearish. It's bearish, but I'm expecting it to hold up in this area of congestion here. So I'm going to take a trade from our list that where we think, hey, implied volatilities are likely to go up. We're going to look at our positive Vega trades and look at them. And we said long call, long put. I'm going to focus on, you can do a calendar, which is a little bit more neutral. You can do that. And a diagonal. That certainly would fit the bill. So let's take a look at that. Now, what I'm going to do here, first of all, let's talk about, to Chris's question, large node likely a support. That's the theory. Yeah. If this is below, this is likely to be support area. Let's say we shot back up. Where would we consider a likely resistance area? Probably up here, where this other node is, right? This is called the point of control, I think is what they call that there. That's the single highest level of trading is right there. But look at, in general, I look at the peaks, okay? Look at the peaks. So we're going to consider that a support area. Let's look at a diagonal spread here. And let me get, we're doing Starbucks here. So that was called the volume profile, for those of you who missed it. Volume profile. Let's go to add simulated trades. And look, this isn't a long-term trade. That's one of the things when you're choosing expiration dates. If I think this is going to go down here and stay in this area for the next couple months, my expiration date is going to be very different than if I think, hey, it's likely to go down here short term. And that's what I'm going to be looking at, is short term here. So you have your choice. I'm just going to go out a week to start. We can tweak this, of course, and you can tweak this. And I'm going to go and I'm going to sell. I'm going to go up here, and our stock's at 99. I'm just going to sell a little bit out of the money. I'm going to click on the ask price there on that. And what I'm going to do is I'm going to go out a little farther. We'll go to the monthly contracts. I'm going to go, and not going to go the same strike. If I do the same strike, that's a calendar spread, okay? One advantage, well, look, let me add in the 97, and then I'll go to a lower strike down here, okay? And we'll look at the difference just to kind of illustrate. What happened? I'm on the trade tab. I meant to be on the, well, let me, okay, here's what I'm going to do. I'm going to add that. Yeah, let's just go to the Analyze tab. Risk profile, add simulated trades. We said we were going to do the 97 and I think I said 2 weeks. We'll go out a couple weeks. And I was going to start out with the 97. Let's look at the risk profile. That's what it looks like. So that's great. it peaks at the 97. That's a calendar, but I want to increase the probabilities on this, so I'm going to tweak this a little bit. Okay, I'm going to tweak this trade, and instead of let me bring this up so you can see it a little better. I'm going to make this long contract in 99, and that way, if it goes down and maybe the support level doesn't hold, we end up with the higher probability trade on that. Now, the most likely probability, according to our technical analysis assessment, is it goes down and kind of stalls out in this area. Well, that matches where the peak is on the trade, right? If it continues to go on further, that's fine. If it goes against us, that's not fine. We're going to lose money if it starts to go up, especially if it starts to go up above like 100. So we can look to get out in that case. But that's the trade there. So this would be what we call a diagonal spread. Okay. Now, when we look at this, and I go back here, I can look at it and I can see, here's my Vega. Okay. Positive Vega. If implied volatilities increase, it would tend to benefit this trade. If implied volatilities decrease on Starbucks, if they decrease further, that would work against us on that trade. Right? So just be clear on that. All right, let me clear this off. All right. So how do we enter the trade? You can go and click on diagonal up here if you want. And I'm just going to click on this, and we're going to go. We said, well, look, you see, it doesn't know what strikes. Now, if you want to get fancy, you can go and say, well, I want to deep and wide. We'll go diagonal, 2 strikes, diagonal, and see if we can get that. Let's see, we were doing June 5th, and then we were doing 97, 99, and I'm going to click on that and see what we got. And I messed it up. I clicked on the wrong one. This should be positive 99, selling the 97. That's the trade right there, okay? And if we're concerned, we can always analyze it and just make sure it looks good. Click on Analyze Trade. And I had the other one I was looking at there, so I got to get rid of that. And that is, no, I have that wrong. Plus, oh, I have my dates flipped on that. Okay, hold on. You see, I messed that up. That's why I never do it that way, to be honest. We're going June 18th on that. That looks better. That looks better. So the point is, if I go here and I do this trade, you can do you can do what I just did, or you can just go to single. You can go to the individual contracts. You can click on the contracts that you want to do, 97, and you just simply hold down the control key while you do it, 99. And that's the trade it should be, okay? So I'm going to confirm and send. Now, if I want to send this, I can do that, but I can also add in a stop if I want on that. I'm not going to right now. I'm just going to send this right now, actually, but first I want to not put it at the mid price because it's not going to get filled there. I'm going to put that trade in because I want to get to one more trade, and I'm going to run out of time here. Okay, so Lakshmi says, the IV is down here, okay? What does this mean for the trade? Well, it means people are expecting. What does it mean? What does implied volatility means? Think about the term implied or expected, okay, volatility of what the stock is going to do and also what the options are going to do, technically. how much movement are we going to see in those options? The expectation is the option volatilities are going to go down in the future going forward. Okay, this is a forward-looking expectation. Implied volatility is different than historical volatility. If you see something with a high implied volatility, people are willing to pay more for options. Like back here, people are willing to pay for more for options because they expected a bigger move going forward in the stock. Right now, the expectation, whether right or wrong, and people get it wrong all the time, is that the future move is going to be less. Okay? Let's look at one more. This is another one that was on our list here of low volatility. Either way you want to look at that. You can see where IVs are right now compared to where they've been. And you can say, ooh, I wanted to look at this from this standpoint, though. It was kind of trending up. Right now, it's possible, I would consider this maybe kind of a key level. And if we break through this, it could move a ways to the downside. But if we continue up, then it may make a pretty good move up. So what I'm going to do is I'm going to go back to our list, and I want to do kind of a two-sided trade. In other words, I want to trade positive vega that if it goes up a bunch, I'm going to do well. If it goes down a bunch, I'm going to do well. But if it just kind of stays sideways, it's probably not going to do so well, right? I mean, ideally, it does well in any circumstance, but that's not how trades work. We got to pick something. So I'm going to do a long straddle on this one here. So I'm going to go to the Analyze tab. I'm going to go to, I don't know why that got, I'm going to go to CVS. That is not that. And I'm just going to look, and I'm going to go to, I'm going to just go at the money, basically. The stock's at 91.5. And I'm going to go to Add Individual Trades. Scroll on down. And I'm not going to go out far. Okay? I'm just going to go short term. Maybe let's just go out a week here on this. See how cheap it's going to be. I'm going to change this to straddle just to look at prices. This is to buy. Straddle's buying a call and buying a put. The cheapest price should be kind of like right at the money. Stock's around 91. I could go for a little over 250, 260, 270, 280, 270, 280. Okay? That's what we're going to be looking at if I click on that. I just clicked on that. Let me analyze this trade and just take a look at what we got. Okay. What do I got here? I'm already on the Analyze tab. This is what it looks like. We want the stock to go up or down, doesn't matter. Expiration is June 5th, excuse me. Let me set my slices to break even. And basically, we wanted to go to 94 or 88 or further. 94 or 88. That's about here, right about there. 88 is about here, roughly. Obviously, this is not exact what I'm drawing there. Given this chart, do I think it's going to do that? Maybe, maybe not. That's your choice. It seems reasonable to me that it would. It seems like we're in a little consolidation. Often they break out in that case. Our IVs are low. If it does break out, more than likely we'll probably see an increase in the implied volatility there. Oh, by the way, there's a survey link in the chat, everybody. So I appreciate your feedback. Would you just take a minute and fill that out? That would do me a favor. And if you did like the session, I appreciate a thumbs up on that. Helps me out on that. And we appreciate your feedback. I also appreciate James for helping me out here in this. And I'm going to throw in that trade. So let me go back here. I'm going to right click on this. And I'm going to confirm and send. And actually, hold on. I'm going to make this so it fills. And I'm going to send that order there. Okay, everybody. Hey, make sure you subscribe to that Trader Talks channel. That way you don't miss out on future content there. We teach a variety of webcasts. I already mentioned that advanced charting techniques webcast, but we have many more. Coming up next, we have market and sector analysis. Today, we talked about implied volatility, scanning for implied volatilities, and doing trades based on implied volatility expectations in addition to just your technical analysis as well. And hey, appreciate it if you fill out that survey link in the chat. Everybody have a nice rest of the day and a nice weekend ahead. We'll talk to you later. Bye-bye.